Hi everybody, welcome to the first in a series of video lectures about Chapter 8, Accounting for Long-Term Assets. A plant asset, or property, plant, and equipment, must be tangible in nature. In other words, you can see it, you can touch it. Examples would be machines, buildings, vehicles, furniture, things on that order. Those assets must be actively used in the business operations and must be expected to benefit future periods. When you're talking about the cost that you're going to capitalize, you have to include the purchase price plus all expenditures needed to prepare the asset for its intended use. Those acquisition costs include all normal and reasonable expenditures necessary to get the asset in place and ready for its intended use. For the acquisition of machinery and equipment, you would include the purchase price plus sales tax, plus transportation charges, insurance while in transit, and costs to install, assemble, and test the equipment. All of that would be added to the acquisition price for the machinery and equipment. For buildings, if you purchase the building, you would include the cost. If you built the building, you would include the construction costs. You would include title fees, attorney fees, brokerage fees, etc. Land improvements. As we discussed in Chapter 3, you never depreciate land. However, we do depreciate land improvements. Land improvements include parking lots, driveways, fences, sidewalks, shrubs, landscaping, and lighting systems. And when you have acquired land, you include into the cost of the land that you acquired the purchase price of the land, title insurance premiums, surveying fees, title search and transfer fees, and real estate commissions. Sometimes you capitalize the cost of the property taxes. Most often, after you own the land, the property taxes are included in operating expenses in the year in which incurred. And as mentioned before, land is not subject to depreciation. Lump sum purchases are discussed in your textbook on page 305. The total cost of a combined purchase of land and building and other assets must be allocated based on their relative fair market values. There's a really nice example in your textbook. I'll let you read that example. Right now I want to go over a different example and work that problem with you. This worksheet has been added to the page in the Canvas modules on which you accessed this video. Please print out this worksheet and work along with the video as we solve this problem. In this example, we paid $110,000 cash to acquire a group of assets consisting of land with an appraisal value of $40,000, land improvements appraised at $15,000, and building appraised at $70,000. Let's add those numbers to our appraised value column. The appraised value of land is $40,000. The appraised value of the land improvements is $15,000. And the appraised value of the building is $70,000. And let's see what the total appraised value is for those assets. The total appraised value for that group of assets is $125,000. We paid only $110,000 for all of those assets, so we got a really good bargain. I'm going to put the actual cost that we paid for those assets right here. So what we need to do is to allocate this $110,000 that we paid for those assets to the cost of the land improvements and the building. And the way that is done is based on the percentage. So land is valued at $40,000 out of a total group of assets valued at $125,000. So what percentage is the land to the total appraised value? Well, that calculation is appraised value of the land divided by the total appraised value of $125,000, and it's 32%. We're going to do the same thing for the land improvements and the buildings. Go ahead and pause this video, get the percentage of each of these assets to the total appraised value, and then total up your percentage column. When you finish that work, come back and see if your answer is correct. When you do the calculations, land improvements are 12% of the total appraised value. And you get that by dividing 15,000 by 125,000. The buildings are 56% of the total appraised value, and you get that by dividing 70,000 by 125,000. Then it's very important to add up your totals, percentages, to make sure that you're talking about 100% of the appraised value. That would catch an important error if you made a mistake in calculating these percentages. The percentages should equal 100%. So now that we know what percentage of the total pot land is, 32%, land improvements 12%, building 56%, then we can apply these percentages to the price that we paid for all of those assets and allocate the $110,000 to each of the assets we acquired. So land is the $110,000 that we paid for everything, times 32%. So of the $110,000 that were paid for these assets, we're going to allocate 32% of that cost to our land at $35,200. You go ahead and allocate the rest of the $110,000 to land improvements and buildings, then add up to make sure that your total allocated cost equals $110,000. Get back to this video when you finish those calculations. So the $110,000 cost is allocated 32% to land for $35,200, 12% to land improvements for $13,200, and 56% to building for $61,600. And when I add up all the allocated costs, they do indeed equal the total of $110,000 cash that we paid for these assets. So I'm going to show you the calculations in case you missed it. So this is just a reminder of how we did these calculations up here. Now we need to prepare a journal entry to record the lump sum purchase of these assets. We're going to need to debit land improvements, debit building, and credit cash. You go ahead and write that journal entry and come back, check your answer, and see if you got the journal entry correct. So here's the journal entry. We debit land for $35,200. We debit land improvements for $13,200. We debit building for $61,600, and we credit cash for the $110,000 that we spent in acquiring this group of assets. That $110,000 right there. Well, that's it for this video. Come back to video number 2 and we'll begin discussing other aspects of property and equipment, including straight line depreciation.